Hello and welcome to the CNBC TV18's Mumbai studio. I'm Sonal Bhutra and you're watching MF Corner. And in this episode of the show today, we'll touch upon the mistakes that any investor can avoid while they start their journey in mutual fund investing. How should they start? Which funds that they can pick according to their risk appetite? This and more we are going to discuss with our guest today, Ashish Shanker, the Managing Director and Chief Executive Officer at Motilal Oswal Private Wealth. Ashish, good afternoon. Thank you so much for joining us. And we are beginning a new financial year, and if it is the beginning of investments for a lot of the viewers as well, it's good to understand what are some of the mistakes that are a big don't, something that you should not do at all. So let's get started, and thank you for joining us. So when you're starting your mutual fund investments, according to you, what is the first mistake that you've seen investors make generally, which is very common?
Yeah, first of all, Sonal, thank you for having me on your show. So this is a great topic to debate on. So one of the biggest mistakes that I see investors making when they choose mutual funds is to base their entire decision on past returns, right? Typically, people would look at 1 year, 3 year, or 5 year returns and then decide which are the top ranking funds, and invariably they would deploy money in one of those funds. Now, why this is a very flawed process is if you look at the ranks of MFs based on returns, and we've done this analysis, most funds which are top performing on a 3 year basis, right, in the subsequent 3 years, they become bottom quartile. So the top rank fund becomes, let's say, rank of 150, or the second rank fund becomes the rank of 80. So the point is you base your decision on how these funds have done in the last 1 or 3 years, and then you invest your money hoping that they will continue to do as well in the future. However, data suggests that most mutual funds keep rotating ranks. So the myth of a top performing, the concept of a top performing fund is a myth. So we have a fairly rigorous process to help investors decide, which funds they should be investing in. So basically, don't look at the rearview mirror and decide how you're going to move forward.
At the end of the day, you'll have to move forward and look forward to make that decisions. That makes sense. And this is something that everyone does, that something has performed well in the past and that could be the case in the future as well. But Ashish, the next thing that people do a lot, and that is the question, is having too many funds in your portfolio a mistake?
Look, you need some diversification in the portfolio. At the same time, the right amount of diversification is an art. So to give you an example, most mutual funds, diversified funds, will have 50 to 80 stocks in their portfolios. There are some focus funds who do buy a lesser number of stocks. However, when you combine, let's say, 15, 20 funds in your portfolio, and I've seen a lot of investors do that because over time you keep buying whatever is the flavor of the season or what is recommended, and you end up having a portfolio of 20, 30 funds. What happens is you indirectly end up owning about 450 to 50 unique stocks. And actually, maybe you're better off at that point in time owning an index fund, because an index fund gives you 500 stocks and it gives you a representation across the markets. It's a cheaper way of building such a large portfolio. What I believe is that 5 to 7 funds is a good number in any portfolio. Within that, you can have maybe a couple of index funds and a few active funds. This will serve any purpose, whether it's investing for a goal or whether it is building a portfolio which is diversified. If your corpus is very large, then maybe you could add on 1 or 2 more funds. But I think any portfolio with 5 to 7 funds is a reasonably diversified but at the same time sharp portfolio, because you'll end up having around 150 to 200 unique stocks in the portfolio.
Okay, that's a lot as well. So makes sense. Prefer restricting it to 6 to 7 funds according to your investment style. Ashish, sometimes there's not a particular goal for which people invest. It's usually just get good returns for future. Is this thought process an issue? Is it must for everyone investing to have a goal?
See, actually, it depends what stage of your life cycle you're in. Let's assume an investor who's created wealth and now managing that wealth to create some returns or to pass it on to the next generation. Then at that point in time, not having a specific goal, but ensuring that your portfolio gets an optimal return is a great objective to have. But most households, have goals to fulfill through their savings, whether it is buying a house, whether it is saving for retirement, or to save for kids. So I would presume that most people who are doing SIPs in mutual funds or looking to allocate their funds in various asset classes are looking to do so for a certain objective. So it always helps to have a certain objective because that ensures that there is a method to how much you invest and how you invest and how you will get to your goal.
Okay, so that is very person specific as well. But let's talk about a generic question and understand how important emergency fund is. Does one need to keep some money aside for that and then invest in mutual funds, or it's okay, you can just go ahead and invest in mutual funds?
I genuinely believe that having some emergency funds is absolutely critical. And again, it will depend on the profile of customers. So, for example, for most salaried people, I would say that having 6 to 12 months of your income or expenses in an emergency fund, whether it is in a liquid fund or some other instrument that can give you liquidity whenever you want, is absolutely critical. Reason being that if you're saving for your goals, you're typically investing as much, you're doing as much allocation as possible in risk assets like equities. And things are quite unpredictable in the shorter term. So let's say if there is a large drawdown in equity markets, and at that point in time there is some emergency, you don't want to disturb your longer term corpus. So having an emergency corpus is absolutely critical, but how much emergency corpus to have will really depend on the profile of the person. So a salaried person may, let's say, choose to have 6 to 12 months expenses in an emergency fund. Similarly, a businessman can decide how much working capital or how much capital the business might need in an emergency and have that amount of capital in an emergency fund, so on and so forth. But I do believe it's a very, very critical corpus to have, unless you are an ultra HNI and your corpus is so large that it doesn't matter. But I guess for most of your viewers, I think having an emergency corpus is a great idea.
It doesn't hurt, right, to keep some funds aside for emergency. You never know what happens. Ashish, if someone wants regular income from mutual fund investments, is it a mistake to invest in dividend funds? Is it better always to invest in growth funds versus, say, dividend funds?
See, actually, if you ask me, the best way to get a regular income from funds is a concept called SWP, a systematic withdrawal plan, right? What it allows you to do is it allows you to invest in products like, see, you can choose your funds like hybrid funds, or there are two types of hybrid funds now. You have the balanced advantage, which is more equity and gets equity kind of taxation. And then you have these debt-based hybrid funds, which get the old long-term capital gains tax benefit that debt funds used to get, right? So these two are great products to invest in and then start an SWP, because your taxation is lesser in these products, and over time, if the rate of return in these funds is higher than the rate of withdrawal, you will also end up getting some capital appreciation. So I believe SWP is a great way of getting regular income back. Dividend funds, when you say dividend funds, I'm assuming you're referring to equity funds which invest in yield stocks?
Yes, you're correct.
So that may not be a great investment for getting regular income. Reason being that in India, given where the valuations are, first of all, dividend yields are very low, right? There may be some companies where the dividend yield is high. So dividend yields are on an average between 1 to 1.5%, right? Plus, since you're investing the entire corpus into equity stocks, the volatility on the capital will be huge. So that makes it very difficult for you to plan a regular income. Whereas, let's say a hybrid fund or a balanced advantage fund will give you a slightly higher level of stability and will help you plan your cash flows much better.
Okay, all right, that makes sense. Taxation also differs for both dividend and growth fund after the recent tax changes that we saw as well. Ashish, we have to slip into a break, but we'll continue our conversation on the other side. But before we do that, here's something you must not miss out on. CNBC-TV18 presents India Exchange, where market experts and industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. Mapping with macros with City India economist Samaran Chakrabarti, cat a jugalbandi between market veterans Manish Chukani Vaswani and Ramdev Agrawal, Return of the Animal Spirit Within India Inc. A conversation with V. Nathan of IDFC First Bank, KK Mistry and Manish Kejriwal of Kedara Capital, and Chasing Alpha with market experts like Nilesh Shah of Kotak, Prashant Khimka of White Oak Capital and Anish Tawakle of ICICI Pru MF. Don't miss out on this. Tune into CNBC TV 18 on April 4th, 5:30 p.m. onwards. Welcome back. You're still tuned into MF Corner. We have with us Ashish Shanker from Motilal Oswal Private Wealth, and we are discussing everything about the mistakes one can avoid while starting the mutual fund investment journey or generally investments as well. Ashish, does the name of the asset management company matter, or should the constituents of a particular scheme, that is something that an investor should focus on?
So, whilst we spoke that the pitfalls of looking at past returns and investing, I think this is a good point to talk about how should then investors pick mutual funds, right? And this question that you ask is very, very related. Typically, what we look at before recommending any mutual funds is a consistency of performance. So instead of point-to-point returns, we do look at 3-year rolling returns or 1-year rolling returns to see how consistently an active fund manager has performed and beaten, let's say, the index. Because if you're going to an active fund, the objective is to beat the index. The second thing we look at is the clarity of philosophy. I mean, what is the philosophy of the fund manager? And the third thing is capabilities. So when I talk about capabilities, basically you're looking at the pedigree of the asset management company as to what is the commitment to India, what is the capability that they've created, what is the kind of bench they've created, and who's the fund manager managing the fund. So to answer your question, Sonal, it's not important just to look at the constituents of the fund. It is also important to see who's the person managing the fund, what is the kind of track record the fund manager has, and what is the contribution of the AMC. Because look, in our business, people also move organizations, right? So if a fund manager moves, you have to be confident enough that the asset management company where you're investing has the infrastructure and the wherewithal to bring in an equally competent or better fund manager than the person who was managing it earlier, right? So it is important to look at these aspects before you choose a mutual funds, whether it is the asset management company, the quality of the fund manager, and the commitment of that asset management company to India, let's say, because we are mostly investing in India-based funds.
And it's not always the quantitative factors, some qualitative factors, the ones that you just mentioned, that needs to be looked at as well. Ashish, is it possible to time your SIPs, that you do it on a particular day and you'll get better returns? Do people make mistakes here?
Actually, this is a very paradoxical question, because the whole idea of starting an SIP is to not time the markets, right? Because over the period, you are getting into the market at various levels, and there are multiple mathematical illustrations which show that an SIP investor has done far better than people who tried to time the market. So I think SIP as a tool itself negates the requirement for market timing. So the answer is no, you don't need to time the market when it comes to SIP. Yes, what you can do, let me add on here, Sonal, is that there are times when markets fall, right? At that point in time, what you could probably do is you could upfront, let's say, the next few months SIP immediately, that can probably add more units to your portfolio and could enhance your return marginally. Because over a longer period of time, it is very difficult to time markets and enhance your returns meaningfully.
I also ask this question because this is a discussion that I see often in a lot of these financial groups, or the queries that we get. Is it a particular day when we can invest, we would get the maximum return? But of course, the point is you cannot time the markets. You wouldn't know when would be the right time. You just keep going and be consistent and disciplined as well. Once you've made your portfolio, Ashish, how often should one review it? Is this a mistake that investors make as well, not reviewing it at all?
So you must review your portfolio. At the same time, reviewing your longer term portfolio too often is also a problem. Okay, because what happens is the human mind is prone to taking decisions. The moment you look at some data, you look at some pattern, because our mind is used to thinking in patterns. So I think reviewing a portfolio is good, but at the same time, reviewing it too often may cause problems when it comes to decision making. So let me give you some guidelines as to how investors should approach it. I think looking at your portfolio every month is good, but every month you need not take any decisions. Every quarter you can spend a little more time, but really the action on the portfolio should happen maybe at best once a year. I think once a year, yearly, when you take stock of how your portfolio is done, how your investments have done, taking stock of whether your goalposts have changed, whether your risk profile has changed, is a very good idea. And if at all there's some rebalancing that needs to be done, then you should do it on a yearly basis. That is our view. Second, time when you should definitely do a slightly more deeper dive is when there is an event. Let's assume that you're investing in equities and you're doing an SIP and you're saving for a particular goal, and COVID happens and you have a 40% drawdown on your portfolio. It's a great time to review what kind of portfolio you have and see if you can upfront few of your SIPs at that point in time, because you're getting better value for your money. Similarly, let's say you have 3 years of great equity returns, and your returns over the last 3 years are higher than long-term averages, right? Let's say long-term average from equity markets 15-16%, and a portfolio is doing 25-30%. Then definitely you need to give a thought as to, do you want to reallocate money from equities to maybe some other asset class that you have in your portfolio, provided you're running a portfolio which is diversified.
Got it, got it. So, we are talking about reviewing your portfolio after some period of time. But if you want to diversify, how do you decide the diversification in your portfolio? How much towards debt and how much towards equity? How can one identify that?
Yeah, so the most important decision when it comes to diversification, Sonal, is diversifying across asset classes. How much do you allocate to equities and how much do you allocate to non-equity asset classes like debt? And of course, gold, which typically we believe is a hedge against any kind of volatility or risk. Okay. Simple rule is, depending on how long your goalposts are, right? How far off your goalposts are, you can take more risk in the portfolio. So for example, if you're saving for a goal which is 10 years out, then you could invest maximum amount of the money in equities, whether it's 60, 70, 80%, you can decide based on your temperament. And the remaining allocation can go into debt or some allocation into gold, right? Similarly, if your goal post is, let's say you've been investing for a particular requirement, and you're 7-8 years out into that requirement, and the next 2 years you need the funds, and you've done well and you've kind of come very close to your goal, at that point in time you can make your portfolio a little conservative and ensure that the volatility in the portfolio comes down, so that you have the money to invest for that particular requirement, whether it's buying a house or a kid's marriage. The other way to look at it, Sonal, is for people who've already built their corpuses and have a very large portfolio. Actually, in most of our clients, we deal mostly with HNIs and ultra HNIs. I can tell you that the wealth is going to outlive them. Right? So the other way to think about it is, this wealth, see, most people think about the time horizon of their wealth, as finite as their own lifetime. But actually the wealth is going to outlive them. So in that case, you can become a little more aggressive. This is very contrary to what most wealth managers would tell you.
Yeah.
At your age, they will tell you that you need to reduce your risk. But I have a little different view, because if you have a large portfolio and your wealth is going to outlive you, you can actually take much more risk because this money is for the next generation.
Okay, wealth could outlive you. I mean, if that is the scenario, I mean, what better than what you are suggesting as well. But you know, one question that we get often, okay, you cannot time the market, okay, you have to do your SIPs every month, but how can one decide the amount of SIPs they should start with? What is the thumb rule here?
So, see, when someone starts working, I think it's just a question of deciding how much you can keep aside, right? It's fine to tell, young people who have started working that, hey, you need to save X, you need to ensure that you keep your expenditure limited. But look, the moment someone gets a first salary or just started working, they want to live life as well, right? So in the beginning of your career, I think whatever you can set aside, that whatever the number could be, 5,000 a month, 10,000, 20,000, 30,000, right? You should start. I think most important thing is to start an SIP. Okay. As you grow in your professional career, right? Your disposable income starts growing along with it. At that point in time, you can then start setting goals. And today there are enough calculators available online. So, for example, if I want to have a crore of rupees after 15 years, right? Today there are enough calculators online that will tell you that if you save X amount of money, you need X amount of return. So the easiest thing to do is, let's say you need a crore after 10 or 15 years, you decide what is the return that you want to model in. Okay. Now I think 12 to 15% return in equities is a decent enough assumption. The calculator will then tell you, if you punch in 12%, how much you need to save per month. Okay, that's a great way of going about planning. And you can do it for every bucket. Some goals may be 5 years out, some goals may be 10 years out, some goals may be 20 years out. But the most important thing, Sonal, is to start initially when you start working, right? Because for people who just start working, if you tell them you need to save X amount of money, it just sounds like preaching. They ain't going to do it.
That's right. And the most important thing also is to have goals. That's the reason, and that's the way you will be able to use that calculator as well. But 1 crore in 10 years or 20 years, whatever it is, you have to start. As you said, that's the most important thing, and the amount will be calculated basis some of those calculators available as well. Ashish, it's always a pleasure speaking with you. Thank you so much for a great chat. So these are some of the mistakes that one can avoid while they're starting their mutual fund investment journey, or they're continuing it. They just need to be little mindful. So thanks a lot for joining us, and we'll be speaking to you very soon again. But with that, we'll take your leave on this edition of Mutual Fund Corner today. But stay tuned for closing bell to take you through the last hour of trade.